Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So, having been away for most of the last couple of weeks, I've missed the two most tumultuous weeks in the market we've seen for a while. Obviously driven by events in the Middle East and the US-Israeli war with Iran. I'm joined to talk about that and, of course, about all the latest investment trust news by Andrew McHattie, editor of the Investment Trust newsletter, one of his regular appearances. So, Andrew, I'm sorry that I haven't been here in a way, but it's been quite dramatic. What's been the impact of the crisis in Iran on the investment trust sector, and what do you make of the fluctuating movements in markets since this all began a couple of weeks ago?
Yes, thanks, Jonathan. Maybe you could let us know when you're going away next time to give us some warning. It has indeed been a tumultuous time. First of all, let's not forget that President Trump had an issue with tariffs just before he decided to attack Iran. So that's all been deflected now. But of course, the Iran war is the main news. And outside of the human cost, that, of course, has unleashed a new oil shock on the global economy, which has, of course, pushed up inflation, reduced the likelihood of cuts in interest rates. And through those mechanisms, it's really affected the entire market and the entire investment trust sector.
Indeed. And that is, of course, something that nobody had baked into their expectations for this year. At least consensus opinion seemed to be that we were moving towards a period of cuts in short-term interest rates, at least on both sides of the Atlantic, and that was deemed to be positive, while we continue to ponder the impact of AI and, of course, as you say, tariffs. The fact that the original tariffs that President Trump imposed are in limbo following the Supreme Court ruling that they were not legal. We don't know how he's going to come back from that, and it may or may not be a coincidence that he's got involved in this Middle East adventure at the same time. Seems to me, coming back here and looking at what's happened, this has been a classic Trump performance, if you like. In the first place, this joint Israeli-US attack shows that he can be and is decisive in a way that other earlier presidents perhaps have not been, worried about some of the other consequences of this war. He's been able to control, if you like, the narrative around markets yet again by doing this and coming out saying it's all going to be over soon and so on. He's tried to control the narrative affecting markets, but with very mixed results. But at the same time, we've also seen his language being hyperbolic. For example, saying we sunk the entire Iranian navy. Well, that isn't quite true. Maybe a third of their vessels are out of action. And of course, he's not being consistent. It's very hard to work out what his actual objectives are here, and maybe he doesn't even know himself, beyond striking a blow against the Iranian regime. So yes, it's a very uncertain picture, and he's been an uncertain president to deal with from the very beginning. I'm sure you'd agree. But this has only confounded it, if you like, on a very important economic matter. So if we look down the list of how the investment trust sector has performed, I mean, the great majority are down. The great majority of equity markets are down. Have you been surprised in any way by the reaction that we've seen, and who's been worst and most affected?
In general, no, I haven't been surprised. And of course, we're all looking for signals as to what might happen next. And as you've spoken to there, really, Jonathan, you can listen to President Trump and what he's saying, but I'm not sure that's going to give you a very consistent market message. I think if you're looking at one indicator that is really telling you where markets are heading, you've got to look at the oil price, because that is really the most important indicator which is being affected by this and which is obviously having such an impact on the global economy. And I think if we're looking at investment trusts broadly and their response, it's been a fairly predictable risk-off response by the market. So the heaviest fallers have been the growth capital areas, the high growth parts of the market, which have long duration assets, not necessarily profitable. And I think investors have been taking some money off the table there. They've been shifting some of that towards, I think, more cautiously positioned assets. So perhaps in the flexible investment sector. And then there have been a few special situations, such as those trusts that do have good traditional oil exposure. So there are a few, like BlackRock Energy and Resources Income, which at the end of January had 26% of its assets in traditional energy and another 34% in renewables and energy transition. Or CQS Natural Resources, which we'll talk about in another context in a moment, I think, where the energy weighting there has doubled actually since the end of December to 34%, when they've taken money out of precious metals. And I think as well, this is quite an interesting point, that the rise in oil prices and gas prices as well has brought some general benefit to the beleaguered renewables sector, because their power price curves, which have been such an important element in their struggles, have been rising because the marginal supplier is gas there. So that's helpful. And finally, especially this is helpful for the battery storage companies, because there has been considerably increased volatility in those power prices, which is exactly what they need to be trading their energy on a daily basis. So it'll be really interesting to hear if those battery storage companies have benefited when they next report their results.
Yes, well, you've summarized that very well. I think the other thing I would highlight would be obviously the countries that are the biggest oil and gas importers have been affected the most. So we're talking about Japan, we're talking about India, and Asian countries generally. They've been obviously hit by the rising oil price. Oil at $100 a barrel is not good news. There's no way you can dress that up as being good news in any shape or form. But as you say, the renewables, yes, I'm pleased to see that. They've had such a torrid time. Of course, what really matters is the price curves over the medium longer term rather than what happens immediately. But it's good to see they've had some respite at all. I mean, I'm looking down the list. Greencoat UK Wind, for example, the largest, is up around 2% over the last 10 trading days, something like that. Bluefield Solar up a bit more. So that's all good. You mentioned the sort of absolute return funds or the defensive funds. And it's good to see BH Macro is flat, hasn't lost money. That's one of its functions, I think. And Ruffer's doing quite well, which is, again, perhaps overdue for that particular trust. So the Investment Trust Index, I think, is down around 4% over the last 10 days or so, which is not as bad as it could have been. But where we go next is pretty much out of our control, right? So it's open season on where we go next, I think. It would be very surprising if people haven't gone more defensively over the last 10 days, despite President Trump's attempts to calm the markets by saying it'll all be over very quickly. It doesn't seem to be the case as of today that will be what happens. So let's leave it there for the moment, and we can't go much further than that, I don't think, with what we know at the moment. Let's talk about something else which has been with us for a while now, but this has also had a late flourish, and that's been the news of what Saba Capital are doing. They obviously have been looking to profit from persuading boards to either wind up or take action to address their discounts. Discounts actually haven't widened that much, surprisingly, on average over the period, which is interesting. So tell us what we know from what Saba's been up to recently and the trust that they've influenced either directly or indirectly in the last couple of weeks.
I think we are entering a new chapter here with Saba, and clearly this is a topic we've been discussing pretty much relentlessly for the last year, or perhaps even longer. It's hard to remember. But I think we've got some fresh news now. Let's start with Edinburgh Worldwide, which has really been the recipient of repeated attacks from Saba Capital. Shareholders have rebuffed its approaches twice now, but it's coming back again and seeking a third vote. And what it wants to do here is to install its own directors, effectively taking over the trust and seizing its assets. And I think it has two reasons for doing that. One is that it really wants to control an investment trust and have that as a vehicle for making further investments in the sector. And secondly, I think it wants some of these SpaceX assets. So Edinburgh Worldwide has been the trust it's really targeted. The problem here is that each time this vote occurs, it really needs a high proportion of shareholders to actually get out and vote. And that's fine the first time. Actually, it was fine the second time. But of course, as time passes, so people become wearied by the whole process. And I think the board has now decided that it cannot keep asking shareholders to rebuff Saba. And it said it has no alternative but to propose an exit. So it has now come up with a plan, which is not straightforward because it does have these unlisted assets, including the very valuable stake in SpaceX. So it said it will offer a 100% exit to shareholders, but with a method to retain access to the potential future value of SpaceX. So that means actually you'd get about 85% of your cash out and 15% deferred until there's a further liquidity event for SpaceX, which could be an IPO. So we don't have the details of that yet. A circular is to come. But this is effectively the board finally throwing in the towel and saying there's nothing else we can do here because this is just going to happen over and over again, and it's costing shareholders money every time. And we've seen a similar thing happen with the Impacts Environmental Markets, where that trust is now implementing its backstop tender offer, again, effectively winding up and offering shareholders a complete exit. And we don't know what's happening yet with Herald, which is another trust currently in discussions with Saba. So Saba's really stomping its way through the sector, ignoring the wishes of the majority of shareholders. And sadly, the result is that we're seeing these investment trusts disappearing.
Well, I remember we raised this issue about a month ago or even 2 months ago. We were saying, this actually poses questions for the London Stock Exchange and for the regulators about the way in which a shareholder with a 30% holding can effectively drive a listed company out of business without ever winning a vote to do so. And that doesn't seem right. It does seem to be an exploitation of the rules, which was not the intention of those rules. So I see the AIC has got involved at last in trying to lobby the FCA to look at this issue. And that's obviously an important development, but I think it could have happened earlier. We did talk about this some time ago. And it doesn't seem to be satisfactory. We've had other cases where investors with 30% holdings have managed to block developments that they didn't like, and that wasn't particularly healthy, or at least try and remain in position as the managers of a trust when the majority of the shareholders wanted them out. A slightly different issue. But I think this does raise some important questions, but it's probably too late now for Edinburgh Worldwide or for Impacts, as you say, to do anything about it. And it is a very sad day. It's not what I expected to see when a minority shareholder could effectively force the liquidation of an individual trust. Admittedly, they both had performance issues. We can't say that Edinburgh Worldwide would have been able to carry on indefinitely, though the majority of shareholders did vote for that outcome. So we'll have to see how that goes. How do you think Saba will react to this? The one thing that also come out, I think, out of the Edinburgh Worldwide situation is they have effectively confirmed that their idea was to win a vote throughout the board and get themselves appointed as manager rather than just having a new management arrangement. So at least we're clear now that what we've all suspected is indeed the case. So if you were a shareholder in Edinburgh, what do you think you would do at this point? Well, you have to come out and vote, I suppose, first of all. That would be the first requirement.
I would certainly want to vote. I would sigh very deeply and I'd feel very sad because I don't think, sadly, there is much to be done here. I think you would just have to take the cash exit and accept your fate. And Saba really is in a heads we win, tails you lose situation here, because either it grabs the assets and control of the trust, which is what it really wants, or if that doesn't happen, well, it gets its opportunity to get cash out at NAV as well. So it's not losing out there. And the risk is that if Saba is able to achieve these kind of outcomes where it's potentially going to get control of a trust, but if it doesn't, well, the trust winds up and it gets its cash out, it's just going to carry on marching through the sector. And I've got a list of Saba's holdings, and I think it has declarable stakes now in 41 different investment trusts, which is a very large number. We really don't want to see all of those disappear. And my eye was really caught by a new stake that was declared last week. And that was a 5.2% stake in Allianz Technology Trust, which has been a fantastic performer. And I really can't believe that shareholders would be unhappy in any way there or seeking any change. It's not on a particularly wide discount. It's about 8.5%. And it's a big trust. It's got about £2 billion worth of assets. So I think that shows that no trust is safe here. And we really do need to put as much pressure as we can on the FCA to review those listing rules as soon as possible. And much as I admire the AIC and the work they do, I would have to say they haven't been quick enough here or firm enough here to really make that point. because we are going to see, I think, some perfectly reasonable trusts disappear before action can be taken.
Yes, and I think the other thing that comes through, of course, is that, as we've said before also, Saba have got approval now for their latest ETF, which is going to be investing in investment trust sector on the same basis, we think. And they're also, of course, getting some realizations from things like Smithson, which is a significant investment they had. So being able to put 5.6% into Allianz Technology, which you say is a very large fund, that's a 90 million investment. They have got a lot of money to play with, and they're going to get more as these situations play out. I did notice, of course, that their closed-end ETF is down 4% over the last 10 days. They're not immune from the impact of the market disruption. We've always assumed that they have hedged out their positions, but we don't know for sure. And certainly their positions in the alternatives might be, again, we don't know how they've hedged that position. So they could be suffering as well, we don't know for sure. But one has to say that their campaign is not finished and could be intensifying. So in another context, really, but related, we could talk about what's been happening at three trusts, in fact, which are being managed by the same team. And these are CQS Natural Resources, Golden Prospect Precious Metals, and Geiger Counter, which is specializing more in uranium and things related to nuclear power. They have all resigned. Now, what is the significance of that? And tell us, first of all, what's happened and then the impact on the share price and what do you think is going on here?
Well, this does happen from time to time that portfolio managers move on in their careers. And I think that's what's happening here, that Keith Watson and Robert Crayford, who are the two portfolio managers for these three trusts, have decided to resign from the management company, CQS, which is owned by Manulife. And they're now serving out their 3-month notice periods. So they will continue to manage these trusts for the moment, but clearly they are moving on. And what has happened is that certainly CQS Natural Resources has served protective notice now against the managers, although that's a 12-month period, so that's somewhat different. And we'll have to see what happens, what the boards decide to do, whether they stay with CQS with some different personnel, or whether, and I think this is much more likely, whether they switch to another firm, probably the one that those two managers are moving to. We've seen that happen before. It's not uncommon. So this is an evolving situation. We don't really know exactly what the future management is going to be here, but my feeling is it will be with those same portfolio managers. But because we don't know that yet, I think if you're an existing shareholder, I would just sit tight. And we did see the prices of these trusts come down initially because this was a shock to the market. And I must say, I thought that was a buying opportunity because I think fundamentally nothing really has changed here. There will be some cost attached to the changes that are likely going forward, maybe a bit of uncertainty, but I don't think it will be too long before that's all resolved.
Well, it's interesting, isn't it, the way the market's reacted? I mean, the shares are down, as you say, but they're also down because of what's been going on around the world. We've seen the change in share prices, and that has included not just the oil price, but also other commodities, metals and so on. BlackRock Well Mining is down 8% over the last 10 days, for example. And these are all down by significant margins anyway, but they're still trading on large discounts. 15% in the case of CQS Natural Resources. I've got 27%, 28% for the Golden Prospect Precious Metals, and Geiger Counter is about 18. So these are interesting situations. You think these trusts are going to effectively disappear, re-emerge in a different format, shall I say?
I think that's exactly what will happen. We'll find out in due course where Keith and Robert are going, which company they're going to. And my suspicion is that these trusts will probably all switch to their new employer. Because, of course, this is very much a realm where you need specific expertise. And no other manager is going to know these portfolios like the existing managers. So that seems the most likely outcome, although it's by no means definite.
And they have, of course, all performed very well. Interestingly, of course, CQS Natural Resources growth and income was one in which Saba did have a significant stake, which they then sold back in September last year, I think. So it's interesting. Whether there's any connection between those situations, I wouldn't like to say. So that's more corporate activity potentially there. are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So what about moving across to a different realm, Pershing Square Holdings? What could you tell us about what's been going on there? They haven't been performing that well either more recently, I think.
It's a real oddity, this trust, because it's a FTSE 100 constituent, one of the largest of all investment trust companies. We would think it would have fairly blue chip credentials as a result, but it's always traded on a pretty wide discount, partly, I think, because of the colourful fund manager. And over the last year, in fact, that discount has averaged 29.2%, so really wide. And it's come in to about 21% now. But I think there's something about to happen which might make a change and encourage that to narrow a bit further. So it's quite interesting. So what Pershing Square are doing they're not actually making any direct changes to the London listed trust, but they are proposing to launch a new closed-end fund in America and also to launch the manager as an IPO on the stock market. Now, they might raise a lot of money for this new fund. It's mooted to be perhaps as much as $10 billion, so that's going to be large. And you would think, well, this doesn't really have any impact on Pershing Square Holdings, but it does, because the terms of the existing fee structure for Pershing Square Holdings, the investment trust, are very complex. And actually, it does mean that if the managers are earning significant fees from this new trust, the new closed-end fund in the US, this may reduce future performance fees on the London fund. So that's one potential small benefit there. I think possibly a greater one is that investors who are considering putting fresh money into a closed-end fund in the US, which will be pretty similar, I think, to Pershing Square Holdings, and they're paying full asset value, are going to have a look at this existing investment trust and think, well, actually, that's a bargain on a 21% discount, so we'll have that one instead or in addition. So I think there's a decent chance here that a bit more attention will be focused on Pershing Square, and that will be positive, I think, for the rating.
I guess there is an issue there around the shareholder base and who's going to be playing this arbitrage opportunity which you've isolated. But I don't think that Bill Ackman, who is the manager of this company at Pershing Square and a high-profile hedge fund manager in the US, he's not particularly going to change his ways, I don't think. So there may always be a kind of Bill Ackman discount involved here, because despite the very good performance over 5 years, the discount has remained surprisingly wide for such a large listed company. Do you think that he has become disillusioned with the London market in any way? Do you think that's part of this, the fact that the trust doesn't get a higher rating? Or is it just the fact that it does seem logical for him to raise money in the US as well, given that's his home market where he's much better known?
It's probably a mix of those things. He is human, so it's never nice to see your work rewarded with a massive discount and a lot of skepticism, even when you've done very well. So I think inevitably he's going to be a bit disappointed at the rating that Pershing Square Holdings has had in London. And he has been wanting to raise fresh money in the US for a while, actually. This idea was first proposed actually last year and didn't get off the ground, but he's going to do it now. And it's quite natural, of course, for him to raise money in New York as well. So I think the two can be complementary. I don't think it's either or. And I don't see any reason why Pershing Square Holdings is not going to continue very much as it was. hopefully it will gain some small benefit from this launch, but we'll have to see.
Indeed, we will. Let's move on then and talk about some of the other, perhaps mostly smaller items of news, but also of great interest. Let's start off with Hydrogen Capital Growth, ticker HGEN, which is one of these smaller specialist energy infrastructure funds investing in hydrogen. That's been the fuel of the future for as long as I can remember, but which has its advocates. Tell us what's happening with this particular trust.
We've had a fresh surprise here, an unwelcome surprise. We already knew that this trust was in a managed realization phase, and it has changed the managers to Red Wheel. And their plan was always just to see what price they could get for the assets, really, and to wind this trust up. It has already raised a little bit of cash, which it needed by selling part of one of its stakes at a bit of a discount. But the process was in its early stages. So it came as a surprise on Thursday this week when the trust said it was going to have a general meeting for shareholders to vote on a delisting. So effectively, the managers or the board here has said that the trust is very small anyway. It's incurring quite a lot of cost here, being a listed company. And also, it's being disadvantaged in its negotiations because it's having to disclose so much information to the London Stock Exchange. So it's proposing that it's going to delist and to become a private company, which will help it to maximize the realization proceeds. That's the argument. Of course, that's not necessarily great news for smaller shareholders who are going to be, I think, effectively locked in here. There will be some kind of market on a matched bargain basis, and there will be updates on the company's website on a quarterly basis. But you're effectively being cut off from trading here, which is why the shares reacted so negatively to this news and halved in value. And that's really because there are quite a lot of holders here who really cannot continue to hold the stock in private form, so they're just having to sell out at any price. So we'll see what happens here. The board said it has already consulted with 50% of the shareholders and that they are supportive. So they are presuming that the vote will go through. That's going to be on the 30th of March, and it does need a 75% majority for approval, so it's not necessarily a done deal. But if it does go through, the shares will delist on the 29th of April, and shareholders will then just have to wait to see how much value can be realized by Red Wheel, the managers.
Yes, I mean, it's going to end up, I think, as another case study in failure, I suppose one has to call this particular trust. I mean, it was listed, I think, 5 years ago and traded at a premium for the first year or so, which was common back then. Lots of new things traded at a premium. But since then, it's been a one-way journey, really, and the shares have come all the way from 100p down to under 5p. So if you are in that position having to sell, you are effectively writing off your investment, I think. So I guess maybe they will get their majority and people will hang on in the hope of better things ahead, which is perhaps the best they can hope for. But again, another cautionary tale. I don't like to talk about these cautionary tales, but it is an example of how even in the investment trust sector where you're buying diversified instruments, you can lose basically all your money. And that's not a kind of reputation that the investment trust sector really wants to have, at least in my opinion. So that's been a shock. It is, of course, now very small, as you say, only 6 million of market cap or so at the moment. There's also news from another trust in the energy sector, and this is in the renewables space, and this is Next Energy Solar, another story that's not been particularly happy. Tell us what the news from this one is.
Well, this fund has been under pressure for a while because it has quite a high level of debt. And we know, because we've talked about this quite a few times, that in the renewable energy sector, there's quite a pull on the managers here because on the one hand, they're expected to keep on paying high dividends. They're also expected to invest in their portfolio. They want to take advantage of their pipeline and they want to repay some of their debt. And of course, they can't do all of those things because there's not enough cash. So they've had to make some tough decisions. And Next Energy Solar Fund was really considering all possible options, I think. Everything was on the table here. So they have now reached a conclusion and they're going to continue with the trust, but they've had what they call a strategic reset. That's what they're proposing anyway. And there are a few elements to this. The first thing is that they're shifting really from being an income trust to more of a total return exposure, targeting about 10% a year returns. And as part of that, they are cutting the dividend. Now, that was about 8.4 pence a year. And under the new proposals, they will cut that roughly in half. And that's going to be based on operating cash flows in the future, less expenses. So it should be more sustainable. But the real reason for this is that it frees up capital for debt repayments. So they are really prioritizing those. And they want to recycle more capital. They want to spend a bit on their existing assets to upgrade them. And they also want to invest more in energy storage. So they're going to add co-storage facilities to some of their existing solar farms. So there's quite a lot of change going on here. But it is interesting to me that the board has decided to make these proposals rather than doing something more radical with the structure, because they have said it would be more value destructive to become a forced seller in the market and to enter a managed wind down. And they didn't see any extra value being created by merging either, because they said actually adding more size here wasn't the answer. So that's what they've gone for. The shares so far have been pretty unimpressed, and I think that's really because so many of the shares are held by high yield investors, and they're of course disappointed that the dividend is going to be cut in half. But this could be a viable future for the trust.
Yes, I think it's something, again, we've talked about, and certainly I think I've raised a couple of times this idea that when you're in a situation where your share price has effectively been in free fall for a while, and you are a dividend stock, if you like, at some point, history suggests that you might have to bite the bullet and do something about the dividend. And therefore, it will lead to some migration in your share register, but it does at least then give you a position from which you can move forward. But again, I think interesting point you make about the fear of being a forced seller. That's obviously been one of the concerns at Hydrogen Capital Growth as well. That affects all the renewable trusts, I think. This idea that you're trying to sell into a market that is weak for the assets, not just for your own shares. So, yeah, they've been tough times for the boards. They have to make some tough decisions. It will be interesting to see how this particular one performs relative to some of the others who haven't yet managed to come up with an answer to the dilemma that you've talked about. Shall we mention a couple of other smaller trusts which we know have a significant retail following, or at least aspire to have a significant retail following? Let's start with Seraphim Space Investment Trust, which has performed until recently very well on the back of the increased defence spending across Europe. A lot of things that it invests in are in the defence-related sectors. What's the news out of Seraphim Space, and why is that of interest, Andrew?
Well, I'm happy to talk about this, Jonathan, because I think we really need a good news story now, don't we? And I think Seraphim Space is a very good news story for the investment trust sector, although one driven, of course, by the bad news of more global conflict. It has benefited very considerably from the prospect of much higher defense spending, because many of its space-related companies have satellites and other useful technology that is increasingly used in modern warfare. And if we've learned anything actually from recent conflicts, it's that modern warfare is very different now. It's really not so much about troops on the ground and tanks and the old-fashioned forms of combat. It's much more now about drones, about positioning, and about aerial warfare. So Seraphim Space is benefiting from that. And we saw that in its interim results to the end of December, where the NAV was up just over 20% to 142.3 pence. And that's in spite of a significant provision being made for a performance fee. So it was basically very good news across the portfolio, with lots of new defence contracts, new equity rounds at higher valuations, because these are unlisted companies. And 7 of the top 10 holdings here are projecting profitability in the coming years. So I think this portfolio is really developing very nicely. And I do think that ICI, which is the top holding, which I think could step up again soon and have another funding round. That's really Seraphim Space equivalent of SpaceX for Baillie Gifford. It really is driving this portfolio. And there's been a lot of positive momentum here, which is excellent news for the trust and for shareholders. The shares have come back up, having had a bit of a setback, and they're back at a premium rating now, which I think is also really interesting, because I think this trust may start a fundraising round quite soon, a fundraising of its own. And goodness knows we need the investment trust sector to be able to do that again. It is notable the managers just raised, I think quite easily, $100 million for another fund that they're running. And I think they'd like some more money in the investment trust. So hopefully they can do that. And I really do think this is a very exciting trust that many investors will have a holding in. For a while, of course, it was exciting in a downward direction, wasn't it? But now we can give full rein to our space metaphors, Jonathan, and say it's blasted off, rocketing skywards.
Yes, I had a quick look at the data here as well, and it's one of only 17 investment trusts which are trading at a premium at the moment. And if you remember, it wasn't that long ago, well, it was a long time ago now, actually. It was 5 years ago that more than half the sector was trading at a premium. Now just 17. And as you say, this has been one of the real success stories more recently. It is trading 150p, well above its issue price, and so on. So that's good news. What about Cordiant, another one which I think has a following? Again, we're notable that the manager of the trust, Stephen Marshall, the CEO, has been buying a lot of shares in this one. The share price has performed in inverse relationship to Digital 9 Infrastructure, which is the other trust in the digital space. Tell us what they've had to say and whether you think that's good or bad news as well.
It's a slightly tough environment when there are two trusts that the market initially perceives as doing the same thing. And one is a complete disaster, which was Digital 9 Infrastructure. It really does tarnish the reputation of the sector. But I think Cordiant Digital is moving past that now, because the market, I think, is increasingly recognizing that this is a much, much better quality trust. And that's been recognised, I think, quite broadly now. It's planning to move to the main market, which I think may enhance both its reputation and its rating further. And just as a small aside, actually, before I move on, I'll just mention that a really small trust, Onward Opportunities, is also planning to move to the main market from the AIM, which I think would be excellent news as well. But coming back to Cord, I think this makes good sense. The trust, I think, should join the FTSE 250 index and will attract further demand because of that. It has £1 billion of net assets, but it is still trading on a 24% discount, which seems rather wide, I think, considering its track record and I think many positive tailwinds that it has. It has been a fairly successful investment trust. It's just passed its 5-year anniversary. And I think it has some quite good sale points at the moment, some quite good selling points which would attract investors, including the fact that it has data centers in its portfolio. So you could say that's part of the picks and shovels AI story. And there are some risks here. I think there's quite a punchy exposure to certain assets, and those are in countries like Poland, Czech Republic, and Ireland. So you've got to be comfortable with that. But if you are, I think this is a really interesting portfolio, and I think it's well positioned at the present time.
Okay, so that's Cordiant. Let's then mention, I think finally, a trust that is also very widely held by private investors, and that is Alliance Witan, which is obviously a result of a merger between the Old Alliance Trust and Witan not so long ago. What do we know about them? They produced some results which I think have been rather disappointing, have they not?
Well, Alliance Witan is a big global trust that will be owned, I think, by many listeners to your podcast, and it's worth talking about. I think this is quite intriguing. It's done really badly, actually, Jonathan, over recent periods. There's no way of sugarcoating this. In the 2025 calendar year, its net asset value total return was 4.7%, which is way behind the MSCI All World Index, which was up 13.9%. It's way behind most of its peer group. It's been poor. And actually, this terrible year that it's just had means that, in fact, this multi-manager strategy has now underperformed since it came into being in 2017. So this is really bad news for Alliance Witan. it's had a terrible year, and this is really down to poor stock selection. And that poses a question, doesn't it? Now, does that undermine actually the arguments of the managers that they're appointing exceptional sub-managers for their portfolio and that they know how to really extract alpha from the markets? Because their track record says, no, this isn't what they're doing. The counter argument and the excuse, if you like, is that actually markets have been unusually driven by a small number of stocks. We all know about the Mag 7, about the AI bubble. There might not be a bubble, of course, by the AI companies. And so they're saying, well, their sensible selections have been underperforming. They're different from the market, which demonstrates that they are stock picking. But I think it's quite hard to make a case for it at the moment. And I suspect if you were coming to this global sector as a fresh investor trying to pick a trust, Alliance Witan wouldn't be the one you would choose.
Well, I think certainly on recent performance, you'd have to say that was the case. Of course, these things do go in cycles, but that's no comfort if you're on the wrong end of it at the moment. And as you say, I think to the extent that it's the result of poor stock picking, that is the whole strategy of the trust. So it is certainly concerning. I could not agree with you more. And there are, of course, lots of alternatives out there in the investment trust space that offer you this kind of global exposure, who have done much better. Well, it's a large trust. They obviously got much larger after the merger. It has a market cap of around 4.6 billion. Trades on a discount of around 5%, which is not out of line with the rest of the sector. In fact, slightly better than one or two trusts that are competitors, I suppose you'd say. It's better than Bankers, better than AVI Global, better than F&C, which I think we've talked about before, is surprisingly on a 9% discount. Has some private exposure there, maybe a factor. So do you think this is actually going to lead to any kind of significant action? Can the board actually think about changing direction again? Is that realistically an option? Is it too early for them to say this isn't working? I think I recall that their target was to beat the world index by 2%, I think, over time. And obviously they haven't done that. So this is one of those tough decisions that boards face. Should we think about a change? Are we going to do so just at the moment when things change and we get a better performance record? It's a tough one, isn't it?
It is a tough one, and we've seen plenty of examples of boards changing horses at exactly the wrong moments mid-race, just as things were turning around. And I think in this case, you've got to give the managers a bit more time and accept that actually last year was perhaps not a typical year of normal trading activity. But of course, this kind of underperformance can't go on for too long, particularly if it does start to encourage selling and if it does start then to impact that discount, and it means that the trust has got to buy back more shares. So I think for the moment, it doesn't feel that uncomfortable for the board. And of course, you're quite right, Jonathan, that no one can beat the market all of the time. Things do move cyclically. Managers go in and out of favour. I just think here that if you do have a multi-manager strategy and you're claiming to be able to pick the best managers for any market situation, you've got plenty of flexibility. And clearly, the managers didn't see these kind of market conditions prevailing. So I don't think they have excelled for their shareholders. And so my feeling is they can't continue to underperform for too long, or the media will get hold of this and there will be pressure starting to build.
Well, I'm just looking at what they say their objective is. We blend the top stock selections of some of the world's best active managers into a single diversified portfolio designed to outperform the market while carefully managing risk and volatility. It's also, of course, one of the AIC dividend heroes with 59 years of consecutive dividend increases. So, yeah, I think it's one to watch. It is a significant player in the investment trust sector. And I think from that point of view, we would wish it well and hope that it can recover. But it does pose some interesting issues. I mean, we have been hearing for a while that because of the concentration in the market, this could be coming to a period when active management and stock picking actually produces superior returns. Well, we certainly haven't seen it yet. Let's put it that way. Okay, Andrew, that brings us to the end, I think, of this week's episode. It's been an eventful couple of weeks, as I say. I look forward to hearing where we're going to be in a month's time. We'll come back and talk about the markets again, but thank you for your observations today. It's been very interesting, and at least there's one bright spot in an otherwise slightly disturbing environment. So that was Andrew McHattie, editor of the Investment Trust newsletter, speaking to me on Thursday afternoon.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.